Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, the market is off to a fantastic start year to date. January had one of the best months in history. That's great news. Certainly things, at least short term, appear to be improving. So today we're going to talk a little bit about one of the more credible firms' market forecasts. That firm is Vanguard. You've likely heard of it. They're one of the largest asset managers on the planet, and particularly their forecasts over the next decade, next 5, let's say, to 10 years. So we'll dive in on what Vanguard thinks is going to happen with stocks and bonds, just to give you an idea. So they just recently came out with this report. Well, their 10-year forecasts over 18 major asset classes ranging from stocks and bonds could potentially make you a little bit concerned. So for example, they believe that US stocks will rise anywhere from between 4.7% to 6.7% annually over the next 10 years. Of course, on a relative basis, at least since 1928, the S&P, which is the largest 500 publicly traded stocks in the country, have actually averaged around 9.3%. Of course, so what Vanguard is anticipating is lower average returns for US equities. Well, that doesn't likely excite anyone. And here's their specific equity forecast, depending on, if it's US value or growth or large or small cap. So they're projecting over the next decade that the equity market, and even non-US global, will likely underperform historical norms. Well, what do they think about bonds? The traditional bond, depending on how long you go, usually yields 3, 4, 5%. Of course, shorter term bonds are going to yield a little less, but their projections for bonds are really historically around what would be normal. So US aggregate bond, anywhere from between low 4s to low 5s, T-bills, treasury bonds, 3 to 4%, and high yield, also known as junk bonds, around 6 to 7. Of course, US cash has been historically low because we had 30 years really of low interest rates. They actually are assuming that it's going to be a little higher at around 3 to 4.5%. So at least if you're in the bond market, I would say, you're looking at least per Vanguard, of the next 10 years historical norms. But of course, it presupposes that inflation is back down to what the Fed's most recent target is, around 2 to 3%. Well, Vanguard is not the only asset manager that doesn't have necessarily an optimistic view over what the financial markets will do over the next decade. This is GMO, another credible global manager headed by Jeremy Grantham. Well, their projections are not as, frankly, optimistic as Vanguard's, with their US large and small cap projections being around 1%. International, they presume, is going to do better by a wide margin. You could see there international large and small. But the bond market, again, just like stocks, GMO believe that the bond markets are also not going to do as well, with US bonds and international bonds actually having a negative total return. So you may wonder, well, what do I do with my traditional portfolio if Vanguard and GMO are correct? Now, what is a traditional portfolio? Most folks have, whether they have their money in IRAs, 401ks, or non-retirement accounts, most people have a traditional stock bond portfolio, whether they're invested in individual stocks or stock mutual funds or individual bonds or bond mutual funds. Now, of course, some people own a house, or many people own a house or commercial real estate. So there's some traditional asset allocation in that mix. But again, the typical stock and bond portfolio is what most people have. So if the bond market and stock market is going to underperform over the next decade, what do you do with your money? We encourage folks to look at alternative investments. So what are alternative investments? That's really any investments outside the traditional securities like stocks and bonds and real estate. So some of them can include private equity, hedge funds, venture capital, private debt, of course, real estate, managed futures, structures, products, and even collectibles. At the end of the day, if Vanguard and GMO are correct, where the traditional asset classes aren't going to perform, and assuming they're correct, again, one would have to look at, in my opinion, other asset classes to potentially get yield. Now, what's the benefit of alternative investments and having an asset allocation that is in addition to stocks and bonds. In most cases, if you could see here on this chart, if you add alternative investments to a portfolio, it's likely going to lower the volatility and likely, at least based on studies, increase the return over a long period of time. By adding non-traditional investments like private equity, like hedge funds, like, for example, collectibles, like private equity, like private debt, at least considering them, you could likely lower your volatility and potentially increase returns over a long period of time. So again, this study actually was done by Bloomberg. So we encourage folks to think outside the box to non-traditional investments because, again, using Vanguard and GMO as very credible sources, if they are right, it's very likely, something we should strongly consider. Now, of course, no one knows the future, but they have a very, good track record, both of these firms. So very good studies done by Bloomberg and Vanguard and GMO to give them, in their opinion, a high probability of likely being successful and probably accurate, in my opinion, over the next 10 years. So all that to say is, if you would like a second opinion on your portfolio or financial situation, you can go on our website at nicholswealth.com. You can click on the upper right-hand tab here where it says request an appointment, fill out the information, and one of our advisors will reach out to you and answer your questions and hopefully give you some more confidence, and maybe even, of course, if you have an interest, share some ideas on the alternative investment space, some things that we're looking at for clients and over time. And obviously the most important thing you can do, in my opinion, is to consider looking at outside the box investments beyond stocks and bonds. Number one, to, again, presumably lower risk per the study and potentially get a better return long term. Thanks again for watching. Bye-bye.